Good morning, everybody. Hey, it is John Lone King, and it is Friday, October the 10th. Thank you for joining me today. Looking forward to another great weekend, and happy to get it kicked off with you and giving you an update on what the heck is happening in the market right now. Lots going on this week, lots of things I want to cover. So first and foremost, the markets are waiting. They're waiting for the next data release. They don't know what to do. And the problem is that the federal government is shut down right now. So we're not getting the data that we need, and it is putting us in a position where the market doesn't know how to react. We don't know what the jobs numbers look like. That was supposed to be out a week ago today. We don't know what the unemployment numbers are going to look like. And so we're basically in a position where, you've got to make decisions in uncertain conditions. The Fed is having to do that. It's putting pressure on the markets because they don't know how to read the tea leaves when there are no tea leaves. And so what we've got a lot of uncertainty right now. The government shutdown is creating a major issue and is delaying a lot of the data. And the Fed is meeting in 2 weeks, week and a half, 2 weeks. That Fed meeting, everybody expects interest rates to drop. They expect that we're going to see another 0.25% rate drop. And then 6 weeks later in December, another 0.25% rate drop. But that's already built into the numbers. And so everybody who says, I want to wait until the Fed's going to lower interest rates, hear me, like I say every single week. That is not going to happen. Rates are not going to fall because the Fed drops rates in 2 weeks. Do not wait to lock your interest rate until the Fed drops rates in 2 weeks. Because what happened last month is the Fed dropped interest rates and rates went up as soon as the Fed dropped them. Because it's not about what the Fed did, it's about what we expect the Fed to do and what they say during that meeting about what we expect them to do into the future. Now, here's an interesting thing. I just saw in the Wall Street Journal yesterday that the department in the federal government that handles the data, the unemployment report, the inflation report, the biggest inflation report every month is the CPI, the Consumer Price Index. Well, the CPI is a lot of important things that it's looked at. Most importantly, we think about is the Federal Reserve and how they decide interest rates going forward based upon what's happening with inflation. And this is one of their favorite inflation reports. Well, guess what? The CPI does something else. The CPI is used to determine the cost of living increase every year for Social Security. And what happens, the federal government's tax year, fiscal year ended September 30th. So we are now into a new year for the federal government. But what they have to do is they have to figure out what was the inflation during the year from October 1 of 2024 through September 30th of 2025. That level of inflation is what Social Security uses in November and December to calculate new Social Security payments in 2026. If the government is shut down, those numbers won't be able to be provided. It's going to create problems for people. And so the government is calling back in workers. Now, mind you, these workers aren't going to get paid. They're going to be paid at some point in the future, kind of like your TSA workers, kind of like your air traffic controllers, any essential jobs. They're calling this task of creating the CPI report an essential job. Why does this matter? Because this is actually a very important report for the Fed when they meet in 2 weeks. And so if this report, which is supposed to be released next week, but it may not be because it might be delayed since these people have been on furlough for the last 10 days, but if they do release it before the Fed comes out or meets, now we've got a situation where the Fed is not wanting to lower interest rates because they're afraid of inflation. They need to lower interest rates because of the issue with unemployment, but they're only going to potentially have one of the two data points. They're only going to know what's happening with inflation, which means if that report shows inflation going up a little bit, the Fed is going to say, guys, we're super worried that inflation is going to keep going up, so we're not going to lower interest rates. And the only reason we should lower them is because of unemployment, and we don't know anything about unemployment. So they're making a decision based on half of the information that can be catastrophic to the current trend in interest rates. Now, the current trend in interest rates actually is up. So to say that it would be catastrophic to that trend may not be the worst thing. What I'm saying is the trend for the last few months has been interest rates going down. And I'm going to show you, share screen, and let me share this entire screen right here. All right, so, and there we go. So what you are looking at is you're looking at interest rates going back Here we are. This right here is September 16th. This was right before the Federal Reserve. My finger right here is pointing on September 16th. That was the low point of interest rates. A 30-year fix, technically, the couple of days before had been around 6.3. We had fallen very quickly. We were at 6.14 on the average for a 30-year fixed interest rate, and we immediately shot back up. Guess what? That literally coincides with September of 2024. We saw almost exactly the same low point in September of 2024 as we are seeing right now. Let's see if I can zoom out just a bit. And will you let me, that's not what I wanted to do. Will you let me draw a line? Will this one let me draw lines? I don't know. Yeah, it will, right here. All right, so I have a line right here that shows where interest rates hit at the bottom. And, come on, John, here we go. Come on, computer, don't do that. There we go, perfect. So we basically hit exactly the same bottom, September of last year as September of this year. But what's happened since then? Rates have gone up, they came back down and touched that bottom, and then they went up. And by the time we hit the 1st of October, it was right here. So this is the 1st of October. This is where the numbers were right here. And then we hit the 2nd of October, and then the 8th of October, and numbers went up, and rates went up to 6.6. And then the 15th of October, they kind of steadied out, and then they shot up again. And by November 6th, rates were at 7.1%. We went up 1% in interest rates, okay? 1% increase in interest rates over that timeline. So if I look right here where we were at the low end, and I go right here to where we hit at the high end, these numbers right here were a 1% increase in interest rates in a span literally from September 17th through November 1st. That is a horrible trend that we are unfortunately repeating. Now, I don't think it's going to be anywhere near as bad, but it kind of looks similar. We shot up. Now, we shot up more this time. We shot up more, and now we've stayed longer within this range. So this range is a helpful range. It shows that, hey, we're kind of between here. Oops, you're going to let me do that? Nope. I got to click this button again. All right, so we're between here and here. Got to click the button again, John. And here to here. Okay, so that range is holding pretty well. That says that we should stay within that range. And the good news is, if I zoom in on this, we're actually at the lower end of that range right now. So that's kind of how interest rates operate. They move within a range until they break out. And so we're in a little range right here that's been pretty consistent since the day after the Federal Reserve met. That is good news that we're seeing from September 18th through today. We've been bouncing up and down, and we're technically at the lower end of that range. What would be really, really nice is if we could fall below that. If we could go back down, that's good news. If we break out above, that's bad news. That's kind of how this whole interest rate dynamics work. So it's a good sign for stability right now, but I am super worried about what that's going to mean when it comes to the inflation report and the timing of the Federal Reserve, that the Fed may say, hey, we only know information about inflation, and inflation's moved up. So if that report comes out and inflation is higher, buckle up. If that report comes out and inflation is lower, then hey, they're going to say, hey, maybe we should lower rates more because we have confidence inflation is under control and we have no clue what's going on with unemployment. It's a really difficult thing to predict because, again, we're all trying to read the tea leaves and there ain't no tea leaves to be read. And so now we're trying to read clear water. Like you can't, hard to read that. Okay. Now here's something you can read. I read it this morning in the Wall Street Journal. Auto delinquencies are reaching, well, I don't know if they're record highs. Maybe I said that wrong. They're on the rise. So we're seeing automotive delinquencies. I'm going to change this because I don't like how it, you gonna let me edit it on the fly? No. Yeah. Auto delinquencies growing. Perfect. So that way, if somebody just looks at this, they don't think I'm trying to be a sensationalist. All right. So auto delinquencies are growing. We are seeing a higher number of auto delinquencies, specifically in the lower range of income bands. Now, here's kind of a backstory. We had right after 2021, 2022, as we see inflation start picking up, we see problems with the supply chain. We saw new car prices shooting up. And so people at the lower end of the income spectrum said, hey, I can't afford new cars anymore. They started buying used cars. They started buying used cars and stretching it out over longer periods of time to repay it back for a longer period of time. And now they can't really stretch it any further. They can't downgrade to a less expensive car. They already bought the less expensive used car. They can't stretch it out to a longer term to lower the payment, and they can't get a lower interest rate because interest rates aren't lower. And so I'm seeing more people. I'm seeing it some myself. I'm seeing it in the news that we're seeing auto delinquencies on the rise. So what's happening? We're seeing early stress signs of household challenges. What does that mean? That means that as unemployment continues to rise, we're going to see more challenges. We're heading into a cycle that the signs are showing is going to be a challenging cycle. Now, I've said this over and over again. When we hit these kind of cycles, it is devastating for the people who are directly impacted. For those that are not directly impacted, it's actually a little bit of an opportunity. And so you have to look at the silver lining in this dark cloud. That doesn't mean that we want it to happen. Doesn't mean that we're happy that people are losing their jobs. Doesn't mean we're happy that people have less overtime than they had before and are having a hard time paying their bills. That is super, super challenging, and I'm very empathetic to that. But for those people who have more stable income, who still have disposable income, this is an opportunity that typically comes with the best of both worlds. We often will see a little bit of a drop in house prices as we head into a market like this, and we start seeing interest rates come down. Now, as we go through a market like this, we see interest rates continue coming down, but house prices start shooting back up again. And so there's a sweet spot of timing. We've been seeing that recently over the last few months, where we've seen interest rates come down in July and August, and then we've seen house prices come down in July and August. Now, I'm seeing in some markets house prices starting to tick up. So we got to be careful about how we time this, but the economy is showing stress. Consumers, we're seeing credit tightening across sectors. We're seeing banks getting a little bit tighter in what they're going to loan to people. That is typically a sign of a market that the banks are saying, hey, I'm nervous that more people are going to lose their jobs. I don't want to extend as much credit to people to put them in a tough position. Speaking of extending credit to people, I'll tell you, I got a lot of people who are interested in first-time homebuyer programs right now. That is probably half of my business. We are super busy. I'm blessed to be busy. I thank all of you for helping me to keep me busy. The fact is that there's a lot of unique opportunities that are out there today. And don't think, hey, the federal government shutting down means I don't have access to these programs. A majority of them, almost all of them, are running perfectly fine without needing help from the federal government. So very, very few issues there. Still a good opportunity to talk about refinancing. I'm having many, many discussions about refinancing. The truth is, very few people are pulling the trigger. And the challenge is really figuring out what's your strike price, what's your point at which it makes sense, and be super, super careful about what you're hearing from the loan sharks that are calling you online. The people who are telling you, oh my gosh, I can save you, 1% off of your interest rate. That's a good deal. Yeah, but they're adding $30,000 in fees. And so you save yourself, $300 a month. Well, that's great, but it's going to take you 100 months to make back that money. You're not going to keep this mortgage for 100 months. So you got to be super, super careful about what you believe and look at the bottom line, because you're adding a bunch of money to your balance of your mortgage when you refinance. Now, whether you're a first-time home buyer or you're a renter right now and you say, John, this doesn't apply to me, it does. Hear me now to learn the lesson. Refinancing is not bad. But refinancing without understanding the pros and the cons, without understanding the short-term and the long-term benefits and the short and the long-term drawbacks, can get you in serious trouble. Because a salesperson who's only focused on making a sale is simply going to focus on, hey, look how much I'm saving you in your interest rate. Look how much I'm saving you in your monthly payment. Pay no attention to the fact that I'm taking your 20-year mortgage and putting you out to 30 years. Pay no attention to the fact that I'm adding $30,000 to your balance that's going to take you 9 years to make that back in your monthly payment savings, because all I'm talking to you about is what can I give you today? Now, I'll tell you, for some people, that's genuinely all they need. Now, I have a client right now I have 3 of them, as a matter of fact, that I've talked to recently, who are in a tough position. One of them had a spouse that lost a job. One of them, their overtime went down significantly. The other one is self-employed and their business is slowing down. 3 situations where, look, they have a short-term bind. They are really, really stressed right now on how they're going to make their monthly payments and how they're going to make it through. And so I've told them, look, I don't think the numbers make sense long-term. You're never going to make back the money you spend in fees to do this, but you're never going to make it to long-term if you don't get things right in the short term. If you can't afford to make the payment today, you're going to lose the house to foreclosure. You're going to destroy your credit. You're never going to be able to refinance down the road, and you're going to lose all the equity that you had built. And so the long term only matters if you can make it to the long term. And they're in a position where they're stressed out and worried they can't make it to the long term. Then my focus is, how do I save you money in the short term? Because even though it's not a smart idea in the long term, getting to the long term is still smarter than not getting there. And so that's how you have to really get somebody on your side who understands your needs and can focus on what do you need, not what they want you to need or what they're pushing you to get. So it's very, very challenging, but you need to make sure that you are paying attention to the people that you are getting advice from, the people that are selling you, and make sure that, look, every salesperson, most, have an incentive to sell you. I have an incentive. I get paid when you do a mortgage with me, but I'm trying to give you all the advice I possibly can. And I'm also trying to build trust that I want what's best for you. Now, I think what's best for you is to work with me, but I also think that what's best for you may mean I don't do a loan for you right now, that I tell you this is a bad time to do something, because if I do that, I know you're going to tell all your friends and family, call John King, because if he tells you you should do it, it's because you should do it, not because he needs a paycheck. Okay, I need a paycheck. Everybody needs a paycheck, but I don't want a paycheck at the cost of giving you bad advice, at the cost of advising you to do something that I wouldn't advise my best friend to do. Okay, so it's really, really critical to have somebody who's going to be able to give you good advice. Okie dokie, welcome back. Do people on the DFA loan have to live in the property? Do both people on the DFA loan have to live in the property? Good question. The answer is yes. Everybody on a Dream for All loan, as a matter of fact, most down payment assistance programs, all of them with Cal HFA, all borrowers must occupy the property, and only people who are borrowers on the loan can be on title. Nobody can be on title that isn't a borrower on the loan. Nobody can be a borrower on the loan that isn't occupying the property. Nobody can be a borrower on the loan that isn't a first-time home buyer, which means they cannot have lived in a home. By the way, be careful. All different programs have different rules on how they determine a first-time home buyer. Okay, Cal HFA says a first-time home buyer means you have not lived in a home owned by you or your spouse anytime in the last 3 years. All right, so he says, what if I'm remote? How do they know? Well, you'd tell me. I mean, forgive me, I'm going to use a 5-letter word, fraud. Okay, I'll say it better. I'm going to use the F word, fraud. It's fraud if you lie and you're caught down the road lying about it. Okay, so be very, very careful about that. I am never going to participate in fraud. I want to help give good advice. So sure, how are they going to know? They're not going to know. Like if you're remote, how do they know if you're going to live in the property? They don't. What we look at is your explanation. You're telling me you're going to live there. You're signing the documentation that says you're going to live there. And I'm going to look at where's your job located. So if your job's located in one city and you're going to live in a city that's a 5-hour drive away, then I need to prove that you have a remote job. If you have a remote job, then I trust whatever. You can live wherever and you tell me you're going to live there, then that's fine. That's about the furthest that we can go. So I hope that helps answer that question. All right. What else do I have to go over here? All right. I'm pretty close to the end here. Here's the deal. Right now, I'm getting back into the Fed. Actually, let's see if I got one more comment here. Okie dokie says you're allowed to rent out a room of the property. Yes, you can rent out a room. You can't count the rental income, but nobody can ever stop you from renting a room inside of a property that you own. They could just not let you count rental income from that property for qualification. All right, so let's go back here to how the delayed data is impacting confidence. Right now, smart people who are making decisions, smart people who aren't making decisions, people who are just paying attention to smart people like me, you don't know what to think. We don't know what to think, because when you don't have the numbers, when you don't have the data to tell you how to predict what the Fed is going to do, then you start becoming concerned without real validation of needing to be concerned. And so it creates more fear in the marketplace. And most of the time with fear, people freeze and do nothing, most of the time. And so as we go into this period where we got an economic shutdown with the federal government, I should say, we got the federal government shutdown. We've got economic concerns about the employment picture and job creation. We've got concerns with immigration right now. We've got concerns with inflation. We've got concerns with tariffs. There's a lot of things that are going on, and yet we don't really have a pulse on what's happening. It's like your doctor and trying to say, hey, is my disease getting better? I don't know, because the disease testometer is broken and I can't test to see if you're getting better. And so we kind of have to keep treating you as if it's not working, because we need to make sure that the mistake of stopping the treatment is greater than the mistake of continuing it unnecessarily. That's kind of the decisions you have to make. And so you become less and less confident in your decision because you're throwing a dart. You have no idea what's happening. And so that's what's happening with the key decision makers in the Federal Reserve. That's what's happening with bond traders, who are the ones that are actually setting the interest rates on mortgages, because they're buying and selling mortgage bonds as an investment. And the more they're willing to buy, the lower the rates go. The less they're willing to buy, the higher the rates go to entice them in. It's really that simple. And I've way oversimplified it, but it really is that simple. And so this economic clarity depends on a lot of information. We're going to get another CPI report. Like I said earlier, we just don't know when. That's the inflation report. And they've called back in people that were on furlough at the federal government to have them create that report. But be careful, because that's only half the story, and that could cause a major backfire. So stay tuned. Next week, I will be gone on Friday, so I'll probably end up doing my live stream on Thursday, taking a long weekend. So I look forward to reaching out. If you guys have any questions about anything, please feel free to reach out. You can post comments here, and I'll get back to them later. Otherwise, I'll probably do my live stream next week on Thursday. I will not be here on Friday, and I hope everybody has an absolutely wonderful weekend. We'll talk to y'all soon. Bye-bye.